joining CyberKeep's Cyber Predictions 2024 webinar for what promises to be a really interesting debate. I'm Yvette Essen, Head of Content, Communications and Creative for CyberCube, and I'm your host for today's session. As the industry continues to learn about cyber risk and the best way to manage it, it's clearly important to look forward and prepare for any potential trends. Every year, CyberCube publishes a Cyber Predictions report, and this webinar builds on that piece of research which was published at the end of last year. The predictions were made by a wide range of CyberCube experts who come from a variety of backgrounds, including from data science, threat intelligence, actuarial science, software engineering, and insurance. They touched upon a whole wide range of predictions related to topics such as the continued growth of the cyber market, regulation in the public sector, cyber model development, and the insurance-linked securities market. You can read more about these predictions by downloading the report from our website, but rather than dedicate the session to CyberCube presenters, what we've done today is brought together some of our extremely knowledgeable clients. They come from a broad cross-section of the cyber industry and will voice their views on a few of those predictions. They'll also be bringing their perspective to what they think will happen in 2024. Joining us via a link up from America is Christopher Schaefer. He's Vice President, Head of North American Cyber for Odyssey Reinsurance Company. We have two guests in the studio today. One is Rory Egan, Head of Cyber Analytics for Aon Reinsurance Solutions. Also joining us is Will Finley, Will is Senior Cyber Underwriter for QBE Insurance. Gentlemen, thank you for joining me today. I'd like to start with just asking to explain a little bit about what your roles are within your companies. Maybe starting with you, Christopher. Can you tell us a little bit about what you do?
Sure. So I'm head of North American Cyber Reinsurance for Odyssey Re. In that role, I obviously oversee our North American portfolio for cyber treaties. I also work closely with our international colleagues to ensure that we're bringing global consistency to our underwriting for treaties in all regions, and also have oversight then for strategy and vendor relationships.
Great, thank you. And turning to you, Rory, in studio, what's your role?
Well, firstly, thanks for having me. So I'm Rory from Aon Reinsurance. I'm head of cyber analytics. I'm leading a team of actuaries, catastrophe modelers, threat intelligence specialists, and our role is basically to contextualize risk for our clients at the portfolio level and find reinsurance solutions for them.
Great, thank you. And Will?
Thanks. William Finley, Senior Cyber Underwriter at QBE. We write a broad range of industries and cyber risk here in London, mainly UK and international. Our colleagues in North America focus on that space. But yeah, different size, different sectors. So no, good to be here.
Great. Well, thank you very much. And this is going to be a really interesting debate because we've got about 500 of you registered for today's conference, for today's webinar. We've got so many questions. So thank you very much for submitting many of them in advance. What the format for today is I'm going to ask our panelists some various topics that we think are quite important and have to some extent been reflected in the report, but then we'll be going through some of the questions. I guess for me, one of the biggest questions really is, yes, we have lots and lots of predictions in this report, but what do our panelists think are the main things to watch out for? So I've asked everyone to tell us what their big prediction is. So Chris, I'm going to start with you. What is your big prediction for 2024?
My big prediction for 24 is at the reinsurance level is that this is going to be the year of event covers in all shapes and sizes, whether it's ILS or more formal per occurrence or cap-ons. But, we've already started to see it, and I think that's going to really carry forward in the coming months.
Interesting. And we'll definitely be touching on that. What about you, Rory?
So my big prediction is basically a return to discipline on the underwriting side. I think that we had some really good performance in recent years, 2022 in particular, and now some of those trends are moving away in terms of we're seeing claims possibly increasing in frequency and potentially severity. We've seen rates started to come off a little bit, so I think more underwriting discipline will be required, especially the back end of this year.
And you, William?
Yeah, so echo Rory to a certain extent. I think we're already seeing an increase in frequency of both ransomware, business email compromise, I think that is set to continue. I think we've seen that in the broader sort of cyber ecosystem. I think this year we'll probably start to see that move into the cyber insurance ecosystem as well. So yeah, it'd be interesting to see.
Great. So let's touch upon those. But one thing I really would like to talk about, first of all, is this market that we're in. And we'll go on to rates and we'll go into the hardening market and things like that, all different types of market questions. But a lot of people seem to think this market is going to grow. I think that's something that's reflected in our predictions report. That seems to be a common consensus that the cyber insurance market is well positioned still to continue its strong growth. I'd like to hear your views on that. So I'm going to start actually in studio this time. So I'm going to start with you, Rory. What's your thoughts on that?
Well, I agree generally that there is a strong growth trajectory for the cyber market. I remember sort of back in 2015 or so when I started working on it, we thought the market was about 2 billion. And we think by the end of 2023, we think it's around 15 billion in terms of gross written premium. So that trend in the long term will continue, but I feel like there'll be a little bit of moderation in 2024. And whilst in the past we have, as a market, achieved the lofty growth expectations, we kind of had a little bit of luck along the way. If you look at the top line, so there was a big response to increased claims, ransomware in particular, for a couple of years, and the market responded with significant rate increases. So we kind of reached the previous lofty targets by accident in a way. So I think going forward, yes, there will be growth. It's going to come from not the typical areas like Fortune 1000 companies, but we're going to have to open up new markets, places like China and India, new products, personal lines, cyber, micro, and SME. But I think there's been a couple of publications recently with some really huge growth estimates, and I think a lot of things have to go right altogether and a little bit of luck as well to reach some of those numbers. So I think I'm looking at it a bit more from a moderate point of view on the growth side.
Yeah, and echo that. I think what we tend to look at is sort of penetration rates of cyber insurance. Certainly in the UK and international space, we tend to see sort of SME around that 15% mark, more larger corporate, plus that sort of $1 billion threshold around the 40% penetration mark. So there's going to be a huge amount of new growth. That growth won't come through rate, as Rory mentions, but expect to see new insureds entering the market for the first time to buy that cyber insurance policy.
Turning to you, Chris, in the States, what's your experience at the moment? What's your view?
Yeah, I think there's definitely going to be growth. I agree with all the comments that Rory and Will have made so far. I think in addition to that, we're seeing an increase in limits being pushed up where, insureds are seeking 15 million limits instead of 10 or 10 million instead of 5. And that inherently is going to bring some additional premium with it as well. But overall, we're going to see new segments being accessed, different geographies, or, personal line cyber being added to the mix as well. I agree with Rory. It's definitely not going to be coming from rates just yet, but there's certainly plenty of headroom for cyber to continue its growth trajectory.
Okay, interesting. So we'll get on to rates in a minute, but one of the areas that would result in the market not growing as people would expect it to. I'll start with you there, Will.
Yeah, I think probably education is a huge piece on that. It's something that we've focused on for a number of years now, but cyber is still a new buy for a lot of companies, and it is complex, it's different, and we need to be able to educate our buyers on what that product looks like, what it does, what are the benefits of it. So yeah, we certainly need to focus on that. I think as a market, we've had a few hurdles recently with sort of the war exclusion. I think perhaps that, as I'm sure a lot of us could agree, that has not been simple. And I think we're near a consensus or getting to a consensus on that. So that will certainly help as well.
In terms of what might happen that makes us not get there, I think it's a failure to achieve that new growth. And we've seen certain strategies more successful than others in terms of achieving that growth, in terms of opening up new markets, new territories. So I think more creativity is needed there to get the policies into the hands of the customers, be that embedding with other lines of business or making the whole underwriting process more automated, more frictionless from the point of view of the customer.
Yeah, and I think there's also a data quality aspect to it in terms of there's an expectation to be able to provide greater limits or to be working closer with the insureds, but the insurance companies have have raised the standard for the amount of information that they're used to receiving in terms of being able to underwrite a risk. And if any of that data were to start to fall off, or if there's challenges in these newer segments, regions, or company sizes, as the industry is trying to access those new areas, if we're not able to get the data that we need to underwrite these risks properly, then it's going to hinder growth plans, because I think cyber insurers in general have gotten more firmly embedded with the idea of having as much visibility as possible into writing these risks.
Interesting. And one thing that we have already mentioned here is rate. So let's talk about the evidence. Let's talk about the renewal season that just happened. What have we actually seen at the 1/1 period? I'll start with you there, Rory.
So, yeah, highly dynamic market. If we look at the primary insurance market for cyber, our statistics suggest roughly 50% rate increases in 2021. Similar again, a little bit lower, maybe in the 40s, 2022. And then a reversal of that in 23. We're looking at about -5. Surveying across our clients going into 24, it's pretty flat expectations, which I guess in itself says we don't quite know which way it could go, but we're starting to also see markets within markets, if that makes sense. So certain aspects of the cyber market, like the excess market for large risks, we've seen rates come off significantly, whereas it's been more robust on the smaller risks, the micro and SMEs. Some of our clients have managed to achieve positive rates. So it's a real mixed bag, and we're seeing different segments of the market look at rate differently.
What are you finding, Chris?
There's also regional differences there. So figures that Rory just discussed, I agree, that's what I'm seeing as well. But I think when you start to bifurcate between North America versus rest of world, you can certainly see that the US market had more negative rate change, and then international, like EMEA especially, was buoyed with positive rate change even throughout this past 12 months. And so when you look at things on a global basis, it was -5 to flat, and I think projections are kind of right in that range again looking forward for 24, but that some of that is going to come from positive rate change internationally versus the US rate change it's still slightly negative.
Interesting.
The only bit I think I'd add to that is we talk about sort of markets in markets is when we look at sort of certainly from a UK international perspective, the primary space, I think rate has held up a lot more there than it has on those larger higher access towers. So 2 years ago when brokers were looking to build that first 30 million of cover, that was really challenging. That is now more doable, but rate is flatter in that space, but it's coming off a bit more higher up the tower.
I'm going to throw an interesting question here. -5. That doesn't sound great. I mean, what's in it for the market to keep going when you're seeing -5, when you've seen the numbers tailing off? How do you sell that? What does that mean dynamically?
Well, that's an average of many sort of sub-segments of the market. But again, to me, it just points to the need for underwriting discipline and underwriters needing to form a view of what premium adequacy or rate adequacy actually looks like, which is not the easiest question to answer in the world. If you look at the way actuaries price, they're typically looking backwards. And depending on what sort of period you choose, whether that's the last 3 or 4 years or the last 1 year or going back 10 years, you're going to have quite a different view of how to price the product. So I think that'll mean there'll be a variety of views of what rate adequacy looks like. But again, if I was in the pricing chair, so to speak, I'd be being pretty cautious at the moment as these sort of trends of potentially rising claims come to bear.
Yeah, I mean, I don't think we want the -5s to run away with things forever, but I think there's two major factors that help support that environment, and that, you know, the rate change that Rory was just talking about a minute ago in terms of +50 and then +40, those compound over those 2 years. And so even with a -5 now, we're still at a much better pricing level than we were 2 years ago. And that's in addition to having better overall insureds. I mean, when we look at portfolios, the overall level of cyber resilience and cybersecurity controls that are in place now among insureds is substantially better than what we saw a few years ago. Insureds are much more equipped to respond to incidents, to be able to, back up if their systems are locked down. So, we're in an environment where, because people are doing better, we don't necessarily have to keep pushing the 50 plus rate change type approach.
It's a good point. Like at Aon, we have something called SciQ, which we use to track the overall quality of risks, so the overall level of cybersecurity from questionnaires, and we've seen that improve as an index year on year. So that is combating this trend. So it's certainly not a pure price gain.
And yeah, I'm sure we've seen bigger decreases than -5, but that talks to also a lower frequency year in 2022, early 2023. I think Rory's point that we're starting to see that frequency now come back in. We need to be really cautious about how we price cyber, but I think it's a marketplace, and the fact that insurers were no doubt profitable and some highly profitable in 2022 means that you start to see that pressure on pricing come in as more carriers want to write the line of business.
Interesting. One thing I'd like to touch upon is sort of development of market. And one thing we saw obviously in 2023, and we've seen in the first quarter here, is development of the ILS market in particular. I'd be interested to hear on your views about that market and what the ILS sector needs to do to develop itself further and to support this market. Rory, can I start with you there?
Well, first of all, it's been really exciting and impressive to see from almost out of nowhere, we now have multiple publicly tradable cyber cat bonds coming to the market in Q4 of last year. So there's at least 4 that are publicly known about. And in addition to that, we've seen a variety of the type of instruments. So we've seen industry loss warranties, we've seen indemnity products. So it's been really, it's been more than what most people would have expected. What will make that continue? I think there's a couple of areas on the brokers and the deal makers. We need to keep knocking on more doors. There's big pots of investment out there that maybe don't know about the opportunity yet. So that's just trying to unlock that new capital. And for the players who have dipped their toe into the water from the ILS space on cyber, to get them to do even more, I think will be around educating, and hopefully they're doing things like licensing vendor models, talking to brokers around the view of risk to get a more nuanced understanding of what we're doing here. But so much happened back end of last year that I'm curious and wondering whether that can actually be matched this year, because it was a lot. Certainly I know our company and others are pushing to do even more, and I think looking even more to the medium term and long term, there probably needs to be even more differentiation of products that are available to investors. What we've seen so far has been relatively broad, global-ish protection, and I think that's going to go into different directions around maybe specific perils or maybe specific geographies in terms of future instruments.
Chris, turning to you, I mean, Rory asked an important question there. Can that be continued in 2024? What are your views on the ILS market?
Yeah, I mean, education is probably the number one key here. There are so many different approaches to defining an event, and none of them are the perfect answer necessarily. But none of them are wrong either. And so I think it's a matter of making sure that all parties in the transaction are all on the same page about what the intent is, making sure that there's agreement that the wording aligns with the intent, that everyone's willing to improve upon it. So education's certainly going to be key, figuring out how the vendor models factor into quantifying the structure that's being proposed. And then from there, I think, it's just a willingness to have both on the supply and demand side. It's, insurers who want to buy into these structures may look and see that some of the deals getting done aren't the most limit that's possibly out there, especially when you contextualize it with the property market, and to not get discouraged by that. This is a new area that's growing. And so we're going to have to start small with something that's more bite-sized and then scale our way up as everyone gets more comfortable with it.
One thing I'd like to talk a little bit about is, and we touched upon it briefly, claims, claims frequency. I guess one for you here, Will. Are there any sort of trends that we're anticipating in 2024 in terms of claims frequency? Is there a particular sector, for example, that might be under focus?
Yeah, I think as we've already mentioned, we're starting to see claims frequency come back in, both from a ransomware perspective, business email compromise. Industry-wise, yeah, I'm sure there are still those sort of top 10 industries which we regularly see sort of commented on as the most highly attacked, whether that's financial services, professional services, healthcare, manufacturing. which, yeah, they are all being frequently hit. Some of them are investing huge amounts as a result. You look at financial services, a really mature approach to and long-term approach to investing in their cybersecurity. But I think overall, we see all industries now exposed to a cyber event. Just because you're not selling your product on your website or technology is not sort of an absolutely key part of your business, I think any sort of downtime anywhere has a severe impact. So I think that's our overall message of, just because you might not be an online business, it doesn't mean that you don't have significant cyber exposure.
One area that we touched on in the report was the impact of artificial intelligence and claims frequency as well. I'd be interested in hearing your opinions on whether AI is likely to impact that claims frequency. Chris, I'll turn that to you. And what are your views on that?
Yeah, I mean, I think AI is going to play a role in claims going forward, particularly on the frequency side. I like to think of AI as sort of the great enabler of things. It's not going to be a claim vector on its own. It's going to basically lower the barrier to entry for some of these things. If you think about different phishing attacks, then and you just think about the major manufacturers of smartphones and their translation capabilities that they've all been rolling out in the last year or so, it's so much easier to go from a non-English language into English and have the English output be that much more natural. And when you think historically of phishing attacks, the English in those emails is quite an obvious giveaway that it's a phishing email. Whereas now with the improvements in translation, with AI being able to generate email content, I think it'll be far harder for someone to realize that they've received a phishing email, as for various criminals, and they won't have to hire linguists to do it. They'll just be able to plug it into an AI tool.
Yeah, I mean, I completely agree. I think there's another opinion that does that feed into the security space, and does sort of the integrating AI into threat intelligence tools, into threat modeling, does that enable you to spot those trends? So I do see it as a double-edged sword, that it's not just automatically increased frequency. I think it's right, who can build the wall higher in terms of securing yourself. How is AI taking away sort of hours of staff compared to an AI tool that you can use? So I think it's definitely worked both ways.
Let's talk about tools now. We're a CyberCube software modeler, developer of analytics, and you are all our clients. So thank you for joining us on that. But it's quite interesting when we have this debate about data, about modeling. One thing I'm frequently asked at CyberCube is external people ask, how can you use a model such as ourselves when there's less data than, say, than that cat model, which has been around for such a long, hundreds of years, and so much historic data. I'd be interested in your experiences as well. How do you use our models? How do you find that kind of information useful at a time when the cyber threat landscape is constantly changing and the historic data is just so much shorter than for other types of risk?
Well, it's a challenging area. I don't think the fact that less data points are out there in terms of systemic cyber events is a reason to not bother. I think, to talk about CyberCube specifically, the last version, V5, we thought was a huge leap forward. Shout out to Don Laux and team, ex-Aon, on that one. But we appreciate the directional impact from CyberCube and others in the market. There's various techniques that can be applied to get the most out of the limited data sources, data observations that we have. So I think it's really important to analyze those closely and turn those historical events around inside out to look at how they could have been different and turned into bigger events. We've got multiple vendors out there in the market. We, as a modeling shop, we're modeling portfolios on a daily basis using different tools, and I think that's healthy as well to look at some of these models have been built in different ways, and having a multi-model view of the world is healthy as well, to look at the different range of potential outcomes. And with the cat bonds in the market that are out now, plus just on traditional reinsurance, we've seen specific catastrophic reinsurance protections for a number of years now. that's really on the back of the good work that's been done in the modeling and explaining it and ultimately building the trust. Whilst, of course, it's just a model, we're coming a long way. We've done a lot in a short amount of time, and I think that will only continue as long as we keep asking the tricky questions and not just sort of blindly looking at the output and moving on. We need to continue to ask ourselves as a community, does this actually make sense? Can I explain it?
Great, thank you. And thanks for referencing that. Just so that the audience knows, Rory was referencing Portfolio Manager, which is the product which Aon's using it specifically. Well, what are your views on data modeling?
Yeah, I think to your point around we don't have the data of 100 years that perhaps the other lines do. I think with cyber, we're constantly having to look forward. So I don't necessarily see that as an issue. Yeah, it would be great to have all that claims data for years gone by. But actually, when we're thinking about our portfolio, we're having to understand what 2024, 2025 will look like. And actually, what 2022 prior looked like doesn't really matter too much. But yeah, we're using it across our business, from underwriting, from pricing, actuarial. So no, it's absolutely critical.
Well, and I think there's also, we haven't had as many years of experience, but there's certainly been with certain perils, when you make the comparison, cyber's had more incidents per year over that window. I mean, if we're comparing it against something like earthquake or wildfire, then we've certainly had probably ransomware events alone have outnumbered that. So I think that there is data out there, and sometimes you have to get a little creative in the cyberspace in terms of finding those data points. But overall, I think that there is a lot that is going into these models. And from there, I think one of the keys for us has always been just the transparency from the vendors around the model, and understanding not just the strengths, but also where there's inherent weaknesses in the model, so that we can know, maybe there aren't as many data points for certain size companies. And so there needs to be certain adjustments made in that regard. And just working closely with the vendors in order to be able to understand the model as deeply as possible, and then be able to tailor it to each portfolio that you're looking at.
Great, thank you. I did mention that we have got a lot of questions here from the audience, so I'm going to turn to some of those ones here. So some of them are sort of topics that we already touched upon, but there are quite a few here. I've got one here. I think all of you can contribute to this one. Is the primary / reinsurance capacity in the cyber insurance market today adequate, given demand and growth? We touched a little bit on capacity, but Rory, I'm going to start with you on that.
So I'll talk about primary very briefly, but I'm probably more qualified to talk about reinsurance. On primary, we understand it's possible now to build towers of more than $500 million. So that's been improving recently. On the reinsurance side, there's been a lot of appetite and supply coming to market, actually. So at 1/1, I think some reinsurers were slightly disappointed on the back of it, in that they didn't manage to achieve the full level of participation that they wanted to in the market, as the buyers of reinsurance looked at their own portfolios, starting to get more comfortable with the risk at a portfolio level, starting to retain a little bit more of that risk without needing as much reinsurance, and just not really needing more supply right now. So that sort of worked in the favor of buyers at 1/1. But if we go further forward into the future, if we really want to achieve those growth targets that are out there, then we will ultimately need more supply than what is currently available. And that's the whole piece around traditional reinsurance versus ILS, and unlocking that additional capital from ILS space.
Well, I'm going to stay with the reinsurance piece. So, Christopher, over to you on your reinsurance take.
Yeah, I think, it's more, for my perspective, it's about responding to the shapes and forms that the reinsurance is taking. As Rory was saying, some quota share participations were changed, and insurance companies weren't necessarily buying as much as they have in the past. But there were still healthy activity on the non-proportional side, aggregate stop losses, event covers, in all the shapes and sizes. But, so I think it's about reinsurers remaining responsive to exactly how the buyers want to buy, and being able to meet them with the capacity to suit those needs.
Well, is there sufficient capacity out there?
I think from an insurance perspective, certainly from what I see, I think there probably is. Rory mentioned that limit of 500, 600 million. I think that is more than adequate for the majority of the sort of UK and international space. North America is slightly maybe pushing that, but I think that covers the majority. Mentioned earlier around sort of the first sort of primary, maybe the first 30 million worth of capacity, which was really challenging a year or 2 years ago. That's now in a much better place, that you've got multiple syndicates, insurance companies that are willing to operate in that space and take a lower retention. So yeah, I think it's good news from that perspective.
Just to add, I mean, directionally, I think it's quite positive, but I would say 500 or 600 million is not really scratching the surface in terms of what some of the largest buyers would actually like. So they would want more capacity ideally. So we are seeing things like captives set up and even ILS for commercial risks to bring that additional capacity to play. So it's still a bit of a ways to go there, but positive signs.
Interesting, then, just scratching the surface. Great. I would like to ask this next question from the audience related to premiums and rates. What can we expect from premiums in 2024? Any indication that the market will stay flat, or I guess in some cases down 5% or thereabouts? Who would like to start with that one?
I'm happy to see from an insurance perspective. Yeah, I think so far, similar to what I mentioned earlier, primary business, UK, sort of non-distressed, we're seeing that as pretty flat. Higher excess, we're seeing some rate pressure. Our expectation is that will flatten off second half of the year. And certainly as we see more frequency of losses come through to the market, which we are seeing, we expect it to level off, yeah.
Chris?
Yeah, I think I would add to that I've been in a lot of meetings lately with insurance carriers in terms of the like mid-year meetings or just post 1/1 as we look ahead to 24, and many of them are messaging modest growth and being able to bring their portfolios won't stay flat. It's not like they're shedding business because they're trying to re-underwrite the book as they have been in the last couple of years. And it's not like rates going to drive books to double like we have also seen in the last couple of years. But through all the different contributing ways, I think that carriers are expecting to see some uplift throughout this year.
Right. We've got another audience question here, or several questions actually from the same person here. So bear with me. I'll read this out once, then we can decide who wants to answer this. What do you think is a steady state loss ratio for the cyber industry? Can you talk about development patterns? How long will litigation third-party incidents last? What do you think will be the balance between ransomware versus other perils? And how do you see frequency and severity trends? So just to sum up there, question related to what is a steady loss ratio, what sort of patterns are we seeing with regards to litigation? And there's also questions there on ransomware and frequency and severity. A lot to take in there. So let's try and tackle that one. Rory, I'm going to turn to you on that one.
That was 4 questions in one.
4 questions in one.
Okay, so loss ratio. Cyber is a volatile class. We've seen that in recent years, in both directions, positive and negative. And it's also got that tail potential in terms of the latency of claims. We did see in 23 some of the older years, or older underwriting years, having some adverse prior development. And then you've got the catastrophic component as well. So there's a lot of factors going on, which I think therefore means in terms of a target loss ratio, you probably need to be aiming a little bit lower than some of the other lines of business just to allow for all of those various sources of uncertainty. What was the next part?
So that was the loss ratio. Actually, does anyone else want to talk about the loss ratio part?
Yeah, I think I would just add that cyber is still a new line of business. Let's focus on getting profitable. And actually, there are some underwriting years that we're not profitable. So we're not going to get it right every time. But yeah, if we could work towards a consistency of profitability, I think that would be a good starting point.
Great. The next part of that question was, can you talk about development patterns? How long will litigation or third-party incidents last? Does anyone want to talk about litigation?
Yeah, I mean, I can start that one off. I think that we are seeing some shifts in development patterns. It's a little hard to tell for sure how exactly they're going to change. I mean, especially because it's third-party related and that takes so long to develop. I don't think anyone's really rushing to add some heavy tail factors to account for that. But we are getting feedback from claims teams, both at the insurance and reinsurance levels, that claims are getting more complex to settle. Even on the first party side, some of the business interruption losses that are coming through used to just be really, really quick developing, very easy calculations. And with a move away from encrypting systems and more just a data theft related to the ransomware, that's increased complexity, with some increasing challenges in terms of restoring from backups or not. Then I think that's certainly having a role as well. But even with the third-party claims that we're starting to see more of, I think there's also a recognition that as an industry, we're a few more years practiced on this, and claims teams are more aligned with the different lawyers and other panelists that are needed to respond to an incident. They're able to get in there sooner and control costs a little bit better. So I don't know if it'll necessarily revert to the third-party trends from 5+ years ago, but we will see something a little bit more third-party like in the tail that as we go forward, just inherent with those types of claims coming back.
I think it comes back to territory to a certain extent as well. When we're looking in some of the US business, we're seeing sort of higher third-party potential due to the regulatory environment in regards to some of the BIPA lawsuits and class actions, compared to some of the group actions here in sort of the international space, less so in terms of the length of which they carry on for. So yeah, I think territory's certainly got something to do with it as well.
So looking at how one for the actuaries here, the loss triangles, what was being passed from insurer to reinsurer the last couple of years evolved towards this sort of ransomware and non-ransomware view of the world. But Chris basically outlined it beautifully that a ransomware attack now is quite different to what we were seeing 2 or 3 years ago in terms of how that actually plays out because of varying factors. So that split is arguably slightly less useful than we hoped it would be. And this is the challenge with cyber. Every couple of years, we have to kind of recalibrate and, how do we expect different parts of the market or different parts of claims to change. And what I'd like to see more of now is sort of bifurcating the market into larger risks and SME risks, where the larger ones are going to be more exposed to more complex claims with litigation, with loss adjustment on complex business interruption claims, whereas the SME kind of risks may avoid a lot of that, and a shorter duration of claims could well be justified. And if we start splitting the triangles out in that way, we might be able to observe that and take credit for it.
Interesting, because you've also started to answer that question here. That third question was in the big question here, which was about ransomware. What do you think will be the balance between ransomware versus other perils? Maybe I can put that to you.
We're still seeing ransomware account for about 80% of the losses within our portfolio. We expect that to continue to a certain extent. Business email compromise is certainly coming in on the smaller side, pointing to Rory's comments. But yeah, I think ransomware is still a huge part of it.
And finally, that last part of that question was, how do you see frequency and severity trends? What do we expect to see there? Anyone else want to add to that?
Well, I think out in the wild, so ignoring insurance, we've got a couple of data feeds or multiple ones that corroborate each other that ransomware frequency is massively increased. However, I'm wondering whether that's because the cybersecurity industry is just getting better at understanding when it's happened, or they might have mandatory reporting requirements. So the interesting part will be to see how that actually translates to the insurance. On the severity side, this is always one of the most challenging parts to get your arms around, I would say, on cyber. Again, out in the wild before insurance, we're starting to see the ransomware statistics move towards more of the larger risks. So the average size of a company targeted by ransomware, that average size has been creeping up a little bit year on year. So a little bit in the direction of big game hunting. So possibly, yeah, fewer targeted companies, but bigger loss amounts on the severity side. But again, that's before insurance. And once you factor in things like deductibles, and that's another positive thing that the market's done the last couple of years. The average deductible or self-insured retention is a lot higher than it was. Will we see that potential severity in the wild translate into claim severity for insurance?
Yeah, I think it's about maintaining the right perspective in terms of when we look back for frequency assessments. I think 22 was such an anomalous year in a good way that we just need to make sure to maintain the bigger picture in that. So seeing huge year-over-year increases from 22 to 23 doesn't necessarily mean that there's going to be this big hockey stick of change going forward. I think it's about maintaining a slightly longer view, do a little bit of actuarial smoothing on on the multiple years of history that we have. And then, I think it's about just understanding different aspects, like with touching on the frequency versus severity split. There's been reports about how with non-payment of ransoms going up, people not paying ransoms as often, the ransom demands themselves have been increasing, because if you're going to get paid less, then you need a bigger payout when it actually does happen. So I think some of that will contribute to, an overall flat when you combine frequency and severity. And then it's just a matter of understanding on the third party side how some of those claims end up settling. I think there's still some question marks around the severity of fines that may be levied related to some of the American legals, frameworks that are being litigated on right now.
Did you have anything else to add to that?
All good.
Oh, brilliant. Great. These are fantastic questions. There's so many of them. So I'm trying to get through them. So thank you very much for sending them in. Moving on, got a good question here. What do you recommend all new cyber brokers learn in their first year? I'm going to start with you, Will.
Yeah, so I used to be a cyber broker, so hopefully it can help. I think it's probably getting your head around the product, understanding what the wording does, understanding the nuances of it. And then also I think a huge part of the cyber product is the instant response. So understanding sort of who those vendors are, how they can come in and help insureds deal with a situation, and how that massively adds a huge amount as a benefit. So I'd start with product and wording.
Chris, would you add anything to that?
So product, understanding the wording was going to be my first answer here. I think it's also about understanding the broader ecosystem that goes on, because there are different cybersecurity concepts, and people might go out and get different certifications, and I think that there's a lot of value in doing that. But just understanding that there's still the human element to cyber in general, and making sure that understanding what's cyber resilience means, and being able to have defense in layers and compensating controls. Like it's not just a checkbox, and not to lose sight of the lengthy questionnaires that are out there aren't going to give the full view of how an insured is set up to handle an incident if it were to occur.
Right, moving on through all your questions. I love the way this one starts. To shake things up a bit, and no need to mention names, but what do you think has been the historic prediction widest off the mark? This is a predictions webinar, so let's shake things up. You don't need to mention names, but what has been the historic prediction that's been off the mark by far? I'm going to start with you, Rory.
I think I mentioned it earlier. It probably wasn't off the mark, but it's again about the growth of the cyber market, and some of these numbers there was impressive growth in the early days, but if you go further and further out, to continue to achieve that 25, 30, 35, 40% growth every single year for the next 5, 10, 15 years. I mean, I mentioned it already. We kind of got there, but it was totally by accident and the fortune of what happened on the rate. So that would have been the answer to that question, but actually it was an okay prediction at the end by luck.
You're nodding there. What do you have in mind?
Not going back too far, but one that comes to mind is in the sort of really challenging hard market of cyber 2021, 2022, I think a lot of people were saying, is cyber insurance longer term insurable? And is the product going to split in terms of, is a ransomware product going to be created and a cyber insurance product move in different directions? And I think it's easy to have that conversation at the time when you're in that really challenging space. But what everyone did in terms of risk selection, risk control, moving retention, moving premium, was a huge amount of work to carry out. But I think it's now showing sort of the positive impacts that all created. And actually the insurance market is very good at that, of actually taking away cyber and going, right, well, how do you run an insurance product? So yeah, I think that one was, in hindsight, probably wrong, but yeah.
Great. Right. Moving on here. Rory, I think this might be one for you. Will more markets start to introduce widespread catastrophic definitions into their policies to align to the models reinsurance?
So this is referring to coverage within an original cyber policy that specifically kind of calls out catastrophic events, where many policyholders in a portfolio may be affected at once, as distinct from the more sort of targeted victim-to-victim kind of attacks. So there's a couple of large market players who do have that sort of concept in their original cyber policies, and I see that as a positive development for the market. I'd like to see more carriers look at that. It's always there's a competitive tension around whether that's considered to be a restriction in coverage, so that can be hard from a competition point of view to do that. But from a risk management point of view, I think it makes sense. You don't necessarily have to reduce the limits, but you just have to carve it out. Then that allows us to price it separately, to aggregate it separately, and then we can do exciting things on the reinsurance side around back-to-back catastrophic protections that line up to the policy wordings. I don't think we're going to see too much more of it, if I'm making a prediction, in the next sort of 12 to 18 months, which is unfortunate. But I do think more broadly there will be greater attention on systemic risk in general and looking at all the heads of coverage from that angle, things like dependent business interruption coverage grants. Does that really need to be provided to every single client all the time and not really priced properly, for example? So if we're going to be doing that, what are the guardrails we need to put around that in order to do it responsibly?
I don't think any changes in that regard are going to happen overnight. I mean, especially in the U.S. admitted market, nothing happens overnight in that space. But I think what we're going to see and what we're already seeing is that carriers are adjusting how they think about it internally and how they track it internally, both from an underwriting perspective and a claims perspective. I think before they push things into their wording, since there has been some change or evolution of how exactly the wordings are used, but insurance companies are going to be setting up their systems to be able to capture the nuance of reflecting widespread exposure, and then on the claim side, making sure that they're collecting the right data points and getting the right level of information back from the vendors they work with to be able to have the insight to, whether it's forensic data or otherwise, to be able to connect these separate claims together under one widespread event or whatever term they may end up using.
Right. Now, I guess no webinar on cyber would be complete without a question on war exclusion, which we do actually have one here. So who would like to answer this? What is your observation of the war exclusion situation in the market? Who wants to go for it?
I can. I mean, a lot of drama, a lot of noise, a lot of unfortunate headlines. I think ultimately when we look back at this period of 12, 24, 36 months, I don't think we necessarily want to relive it in terms of the pain it caused in various quarters, but ultimately it's in my view, it's moving the market into a more robust and positive space. Just the transition hasn't been easy. I think incredible progress was made in terms of modernizing language in 2023, and we'll see that the first sort of couple of quarters in 24. Will it still be a debate beyond that? Yes, but I think it will be a diminishing debate in terms of noise as more carriers and more markets come to terms with that globally.
I've got some more questions here. How do cyber PMLs compare to property PMLs? Who wants to start on that one?
I can start on that. So for the most part, if you look at an insurer's balance sheet, it's primarily dominated by property, but we are now seeing for a limited number of carriers that the cyber PMLs are getting up there or even overtaking the property ones due to the overall balance of their book, where they're doing, let's say, 30-40% of cyber as part of their overall premium. This is something that the rating agencies are starting to pay attention to and beginning to think about incorporating into their rating methodologies for insurance companies. So I'm hoping that will lead to a virtuous circle by which the rating agencies are asking more questions, and in response to that, we see the carriers improve their overall approach to exposure management and to vendor modeling, and see that as a healthy thing.
Moving on from PMLs, how correlated are cyber events in different parts of the world, e.g. US and EU and Japan?
Yeah, I think something that we see is cyber events can be relatively consistent, certainly in terms of response, sort of IT forensics, pretty similar across different territories. What we do see is different is the regulatory environment in which that event occurs. So something in the US has different privacy laws and regulations compared to the UK or Australia. So that's where we see the main nuances come in.
Well, and I think from a propagation event perspective, going back to my actuarial days, my answer would be it depends. There's certain types of attacks that we, in terms of like a widespread operating system vulnerability, that don't have much regional distinction and can have a global, easily spread globally. But then when we think about something like cloud outage, I think there's probably more resilience than people anticipated and less aggregation potential, because as you have different regions in clouds or just different technology utilization patterns, those types of events that people thought would be instantly global are staying more regional, which has been encouraging.
Great. And a question I think we would all like to know the answer to this. What's the most likely source of a catastrophic cyber attack?
Most likely is difficult to answer. I think it comes from things like tech stacks and basically overall interconnectivity. So wherever there are sources of interconnectivity, that's a source of potential accumulation, whether that's the tech stack of, let's say, the German healthcare market. They're all possibly using similar technologies. So if that particular technology is affected, we could see some accumulation. And another main area is around malware and how will it spread. And the more connected devices are, networks are, companies are, then the more potential there is for accumulation events to occur.
Probably the one we haven't thought about yet. I think, I mean, jokes aside, there is some level of, when we think about the major events, I'll call them, but the headline incidents that have occurred, and whether it's Log4j, or some of like the file transfer system issues. I think Log4j was very enlightening in terms of the open source software potential to contribute to catastrophic events, and that's not something that necessarily was on a lot of people's radar. So I think it's just about making sure that we keep an open mind, that we're always trying to look and understand how these very complex technology stacks interact with one another and could fuel whatever the next catastrophic event's going to be.
We are coming up to time. There's quite a few more questions. I'm going to do a sort of quick fire round here to get through some of these. We have talked about different countries and different growth. So I've got a particular question here, particularly related to Asia, but feel free to broaden this out. What's the estimated growth in different markets, which months are we expected to grow, for example? Particular question here, what do we expect to see happening in Asia? Whoever wants to start on that one.
I can. So we track the cyber premiums globally. Asia, if you include Australia in Asia, then it's possibly around $1 billion in premium, we think, give or take. That's really driven by two countries, Australia and Japan. So I think China and India are both, well, obviously in terms of population, they're number 1 and 2. I think by GDP, they're both in the top 5, but we haven't really cracked that. Neither of those countries are in the top 10 or even 15 in terms of global cyber GWP that we see. So a lot of potential outside of Australia and Japan. If we're going to reach those numbers, that's what we need.
Quite a few questions here related to AI as well. I'm going to try and condense this. How do you see the evolution of AI impacting cyber attacks, which you did touch on briefly, Chris, but I don't know if you can expand anymore. What type of attacks do you see impacting the industry?
Yeah, I mean, adding to one of the comments that Will made earlier when we were talking about AI is that it's not just on the attack side. We are seeing the defenders, the insureds, utilizing AI. I mean, even if you look across the different options from the various endpoint software providers, they're all incorporating features of AI into their tools. I think to some extent there have been, I mean, AI can be a very broad term, and some people use it quite liberally. But when we think about antivirus tools, for instance, there's a type of antivirus tool that's been available for over a decade easily, in terms of like behavior-based recognition of bad activity on a network, and that sort of heuristic-based approach has preceded the wave of calling it AI, but is going to look quite a bit like AI in terms of just being able to make decisions outside of is this bad, yes or no, have I seen it before sort of approach. And so, there is going to be AI used. I think that being able to automate things, scale it up, whether it's managing a botnet or the phishing campaigns that I touched on earlier, or whether it's just being able to inject, especially the image around some of the image creation, being able to inject those images into things to be able to achieve a goal, whatever that is. I think AI is not going to go away in that regard, and it's just a matter of how accessible are those AI tools going to be. Some certain tools, the good ones, can be quite resource intensive, and so I think the threat actor groups with better finances are going to be better equipped in order to leverage that sooner. But ultimately, it is going to make its way into more people's hands and play a role in all different types of attacks. But in the types of claims that we're used to seeing, we just may see more of them, or they might take slightly different forms.
Great. I'm afraid we've run out of time for audience questions. I do have one last question to close. And we started this webinar, I did ask everyone to make a prediction. If your prediction does become true, and you might want to briefly recap it, but if it becomes true, what do you think the market should look to do?
So I think my prediction was around discipline, and that I predicted that we would see greater underwriting discipline in the back half of this year. So basically that just needs to happen, I think. And if that happens, then the market will be in a good place to weather the next storm of claims activity.
Yeah, and I think when we talk about underwriting discipline, that is maintaining strong risk controls, risk selection, pricing stability, retention stability. So yeah, I think as we see increased frequency of losses, that needs to be front of center. We don't want the market to be doing this, and sort of that hardening market to come back in. I think that's good for anyone. So yeah, stability would be great.
Correct.
Yeah, and I think, my prediction was around the prevalence of event covers, and I think with greater protection around the catastrophic events, that reduces volatility for insurance carriers. So hopefully they can turn around with more stable results and be able to, provide that back into the market and fuel the stability, but also fuel the growth of the market going forward.
It leaves me to thank our panel of guests, Rory, William, Chris, for joining us today and contributing to what was a fascinating conversation. I do hope that you enjoyed this webinar. CyberCube regularly hosts these online events, and details of our next webinar should be showing up on the screen now. This webinar will highlight the findings of our new Global Threat Briefing Report, which outlines the nation-state and criminal threat act trends that we expect at CyberCube to occur in the first half of 2024. You can register for that webinar now by scanning the QR code or heading to the events section of our website. As mentioned, today's webinar was based on our predictions report, which can be found in the resources tab of our website, www.cybercube.com, along with a variety of other reports, blogs, and videos. If you want to rewatch today's event or share it with colleagues and contacts, look out for a follow-up email with a recording of this webinar shortly. For information about our services, products, or if you have any additional questions, please do email us at info@cybercube.com. For CyberCube, I'm Yvette Eston.